Hello everyone. For this 1-minute time frame strategy, the first thing we need is to spot a strong trend in the financial markets. We'll also need the RSI, and I'm going to share with you the secrets of the 50% zone, which will really help us to buy all along this trend. Third, we'll draw our price zones, our support and resistance zones, in the best way possible so we can use them to trade long all throughout the uptrend. Finally, we'll use Fibonacci retracements to get additional trading signals and to have an even more solid trading plan. To implement this strategy, we'll need to see either an uptrend or a downtrend forming in the financial markets, which we will then try to trade. So the very first step is to wait for an upward movement, as in this example, to start taking shape. And the beginning of this strategy starts with patience. We're going to wait for the market, for the price, to give us a sign that a price zone has been broken, as is about to happen here, so we can confirm that the start of a strong uptrend is taking shape. So for all this part, we just wait. We simply wait for gold to break through this resistance zone that was holding it back. Once that's broken, we want to see what happened here. In other words, the resistance becomes support, and then we'll be able to work with this entire upward trend. So the start of the trading strategy is set in motion right here, once the market has broken the structure to the upside. We're going to start monitoring the market, looking for very specific, very interesting buying points. This is scalping. You have to be very precise when you buy something because you'll need to have a tight stop loss and tight take profits as well. Once the market shows a strength to the upside, what we do is wait for the pullback on the resistance, which has now become support, and we start looking for buys. So we use Fibonacci, which will draw from the low point of the last upward move to the high point of the last upward move. The low point is here, the high point is here. And as you can see, what we can already notice is that the market is going to pull back both to this price zone and to the 38.2% Fibonacci retracement level. First, know that when a strong trend is underway, the market often corrects to the 38.2% retracement level. That indicates a strong, powerful bullish trend. So you can rely on this Fibonacci retracement level. We are going to monitor, in particular, the 50% retracement, the 38.2, and the 61.8% Fibonacci retracement levels. These are the most important levels to take into account. So here, we have a first indicator that the market does not go beyond the 38% retracement. It does not re-enter the price zone here. So this effectively becomes a support. That gives us a second signal, and the third buy signal is on the RSI at the bottom, right here. The market makes a pullback, as you can see on the RSI, around the 50% zone. This 50% zone is very interesting, because when the market is in an uptrend, well, the RSI, overall, as you can see, stays above the 50% zone. And so, when the market comes down to the 50 zone, it's very likely that the price will start rising again. So you have the RSI at 50, you have the retracement at 38.2%, you have the resistance zone, and you also have the price action showing you bullish candles, as well as a break of the previous structure at this level. So you can take this buy position with complete confidence. If you buy in this area, you place your stop loss either below the last candlesticks or below the price zone here. You calculate your risk-reward ratio. It needs to be at least 2 to 1. If you're risking 20 pips as a stop loss, you should be aiming for at least 40 pips as your target profit. Let's see what happens next with the trend. Once this move has been made, what we can do is take Fibonacci again and continue our analysis. We take the last low point of the uptrend to the high point of the uptrend, and we see that on this next move, the market comes back for a pullback at the 38.2% retracement level. Here, we have a second strong buy signal because there's a bullish engulfing pattern in the candlesticks here, which is just beautiful. The market reacts immediately with buying. Here again, we see a bounce off the 50 level on the RSI. We keep the 50 zone as a support. The market then bounces back, so we're ready to go long again. You can go long again at the close of this candle here. Stop loss below the structure, take profit in this area. Once again, you have an excellent risk-reward ratio. And as you can see, it's always the same process. You need to have the bounce off the 50% level on the RSI. You need to have a maximum retracement, at most, to the 0.50 or 61.8% Fibonacci retracement. Often, in a strong trend, it's at the 38.2% level. And finally, you need to have bullish price action. For the next upward move, we can set a price zone, a resistance. As you can see, the market is establishing a range with a resistance zone. This is another type of example that's also very interesting because, as you can see at the bottom, the market had dipped slightly below the 50% level on the RSI. But then it moves back above it. It breaks out right when we break through the resistance zone here, the structure. So you have a buy signal here. When the resistance is broken, you get a second buy signal with the price action. With the price zone being broken, that makes 3. And you have 2 possibilities in this example. Either you can buy aggressively at the close of the candle here to catch this move. Or you can let the entire move play out, wait for the market to correct, place your Fibonacci retracement from the low point to the high point, and see at which level the market pulls back. You can see here that the market stops at the 50% Fibonacci retracement level, which is a level that is also extremely popular among traders. So, similarly, with the price action turning bullish again at the candlesticks here, you can buy again to target the previous highs as your take profit. As you can see, it works perfectly. We're going to target the previous highs with the price here, so you have this whole upward move to make money. That's about 40 or 50 points. So, you have time to make money. You place your stop loss below the last low, under the structure, and you take the majority of your profits at that point. You can let part of the position run and move your stop loss to break even. That way, if the market comes back to your entry price, which is exactly what happens here, well, you exit at 0 with no financial loss and you keep the gains from the upward move you made here.